Hi, and welcome back to ECO152. In this video, we're doing the continuation of Chapter 5. So this is part 2 of Chapter 5. So now we are talking about the expenditure on GDP and GDE, that is the gross domestic expenditure. The expenditure on GDP is equals to C plus I plus G plus into brackets X minus Z, where C is equivalent to consumption expenditure, I is equivalent to investment expenditure, G is equivalent to government expenditure, and X is equivalent to your exports. That is what we produce in South Africa and sell abroad. Then Z is equals to your imports. That is what we buy from abroad. Gross domestic expenditure, on the other hand, is equivalent to C plus I plus G. That is the total value of all spending within South Africa. It includes all the spending on imports and then excludes all exports. The composition of expenditure on GDP in South Africa for the year 2017. So this table shows the composition of South African expenditure on GDP for 2017. As you can see, this is the consumption, and then this is the investment, and then this is the government expenditure. We all add them, and then we subtract the residual item, which is the figure to balance accounts, to allow for the differences in results from the different methods of calculating GDP. And then we add exports, then subtract imports, then we get our total. The composition of GDPs around the world, core figure 13.7. So this table shows the composition of GDP for the US, Euro, China, and South Africa. And something that is of interest is that only China has almost 50% of its GDP consists of investment, whereas other countries it's only like a quarter of their GDP that consists of the investment. So this explains why China is the second world's biggest economy. Moving right along to the relationship between GDP and GDE. So GDE is equivalent to C plus I plus G, as we have explained earlier on, and then GDP is equals to C plus I plus G plus X minus Z. So if you have your GDE and you want to get your GDP, you can simply add X, then you subtract Z, then you will get your GDP. So if your GDP is greater than your GDE, then your exports are greater than imports. And then if your GDP is less than GDE, then your imports are greater than exports. Please note that the difference between domestic spending and domestic production is reflected in the balance of payment. Employment and unemployment. If you remember very well, in the previous chapters, we did explain that one of the primary macroeconomic objectives is full employment. So employment refers to how many people have jobs at the time of measurement, whereas unemployment refers to how many people are willing and able to work but who are unable to find a job at the time of measurement. So the problems that arise when doing the unemployment and employment measurements are: what about the seasonal or part-time workers? What if someone is not actively looking for work? What about someone who is involved in illegal activities? What about people who are in the informal sector? Are they included in the employment measurement or unemployment measurement? So the following sketch provides a detailed explanation of these problems. It provides answers to our questions. So this is the labor market. This is the whole population of South Africa. And then we have people who are too young or too old to form part of the working age population. That is, people who are younger than 15 years old and people who are older than 64 years old. On the other hand, we have the working age population. That is everyone who is aged between 15 to 64 years old. So This is further divided to people who are not willing or able to work, and also those who are willing and able to work. So this is the broad labor force, and it includes discouraged work seekers. So this group of people, that is those who are too young or too old to form part of the working age population, and also those who are not willing or able to work, are categorized as people who are economically inactive in accordance to the broad labor definition. And then coming to those who are willing and able to work, they are further divided into discouraged work seekers, unemployed people according to the narrow definition of unemployment, and then those who are employed. So when looking at the narrow definition of labor force, people who are economically inactive include also those who are discouraged to work, whereas in accordance to the broad definition, people who are unemployed include discouraged work seekers as well as unemployed people, according to the narrow definition of unemployment. And then according to the narrow labor force, those who are unemployed and employed form part of the labor force. The labor force market analysis. The labor force participation rate is the percentage of working age population that are economically active. And then when you calculate it, you say labor force divided by the working age population. Whereas the unemployment rate, you say unemployed people divided by the labor force. This is more detailed in chapter 11. The official measure does not include discouraged work seekers, that is, people who are not actively looking for work. In the last quarter of 2019, the unemployment rate was equivalent to 29.1%. Unemployment calculations. So this is how you calculate unemployment rate. You take the number of unemployed persons, you divide it by the labor force, and then multiply by 100. The strict definition or narrow definition of unemployment. Only those who have actively looked for work but who are unable to find work are counted as people who are unemployed. And then according to the expanded definition, that is the broad definition of unemployment, everyone who wants to work but does not work is included in the unemployment rate. This therefore means that discouraged work seekers are included as well. South Africa's unemployment rate. So this graph shows South Africa's unemployment rate since 1980. As you can see that in 1995 it dropped drastically. However, it has not decreased to that level ever again. It has been spiking, and due to the pandemic, as we all know, that it has increased further and it has not decreased. Price stability. The consumer price index. There are different ways of calculating inflation using various indices. CPI, that is the consumer price index, and PPI, the produce price index, are most referred to and used. These are more considered in chapter 10, and now we'll be only doing the basic concepts. CPI. CPI is the index of prices of a representative basket of a consumer goods and services. So the elements of CPI are as follows: the basket, the weights, the base year, the formula, and then the price collection. Price index number is equivalent to the cost of basket in the current period divided by the cost of basket in the base period times 100. You are always given the cost of basket for the base period. So if the price index is greater than 100, it means that prices have increased. And if the price index is less than 100, and then prices have decreased. The basket of representative goods. It is 1980. People commonly buy video rentals, cassettes, CD players, landline phones. And when last did you buy a cassette? Would it be a representative if no one buys it? The current basket includes minibus, taxi fares, restaurant and takeaway meals, funeral costs, hotel rooms, sports and event tickets, digital video, that is the DVD players, internet services provider cost, food and non-alcoholic beverages, alcoholic beverages and tobacco, clothing and footwear, household contents, health, transport, communication, recreation and culture, education, restaurants and hotels, and miscellaneous. So the calculation of the inflation rate is equals to change in CPI divided by CPI in year 1 times 100, which is equals to CPI year 2 minus CPI year 1 divided by CPI year 1 times 100. Example, in 2015, the CPI was 150, and in 2016, it was 165. So the inflation rate for 2016 was 165 minus 150 divided by 150 times 100, which is equivalent to 10%. So the inflation rate in January 2020 in South Africa was 4.5%. And then the target for the South African Reserve Bank is that it should be in between 3% to 6%. Very high persistent inflation is called hyperinflation, and then high inflation and high unemployment and low economic growth is called stagflation. Negative inflation is called deflation. External stability, the balance of payment. So the balance of payment is the record of transactions between a country and the rest of the world. So there are two major accounts in the balance of payment, that is the current account and the financial account. The current account consists of exports and imports, primary income payments and receipts, service payments and receipts, that is the trade in services, whereas the financial account consists of financial flows like the sale of bonds and shares. This is the example of the current account. You add exports, you subtract imports, you add service receipts, you subtract service payments, and then you add income receipts, you subtract income payments. Then that is the balance on your current account. And then this is the example of how your financial account looks like. This is it includes the direct investment, portfolio investment, other investment, and then you get your balance on financial account. Change in gold and foreign exchange reserves. There is a difference between the current account and the financial account. The change in reserves is equivalent to a current account balance plus the financial account balance. In the balance of payment, deficit occurs when outflows are greater than inflows, and then surplus occurs when inflows are greater than outflows. Both the current and financial accounts can be in a surplus or in a deficit. South Africa exports and imports. So this graph illustrates the exports and imports of South Africa, where the blue line shows the exports and then the red one, it's the imports. As you can see over the years, exports have been greater than imports. That is, the blue line has been above the red one. However, this started to change in late 2009 or 2010 rather, where imports started being higher than exports. So because of the time, again, I have to stop this video here and then do a mini video on the income distribution, which won't be long. That is part 3 of chapter 5. Thank you for your attention.